Hello and welcome to this video on how banks work. Whether you're new to banking or just curious about how it all works, this video will give you a basic understanding of the key concepts and processes involved. First, let's start with the basics. What exactly is a bank? A bank is a financial institution that accepts deposits from customers and uses those deposits to make loans and investments. Banks also provide other financial services such as credit cards, checking accounts, savings accounts, and more. There are different types of banks, including commercial banks, investment banks, and central banks. Commercial banks are the most common type and they are the ones that most people are familiar with. They offer a range of services to individuals, businesses, and other organizations. Investment banks, on the other hand, provide services related to investments and capital markets. Finally, central banks are responsible for managing a country's monetary policy and regulating the banking system. Now, let's talk about how banks use deposits to make loans. When you deposit money into a bank, the bank is essentially borrowing that money from you. In exchange, the bank pays you interest on your deposit. The bank then uses the money you deposited to make loans to other customers. The interest rate that the bank charges on loans is usually higher than the interest rate it pays on deposits, which is how banks make a profit. One important concept to understand is reserve requirements. Banks are required to keep a certain percentage of deposits on reserve at all times. This is a regulation put in place to ensure that banks have enough money on hand to meet the demands of their customers. The reserve requirement is set by the central bank of each country, such as the Federal Reserve in the United States. Another key concept is fractional reserve banking. This means that banks are only required to keep a fraction of their deposits on reserve, while the rest can be used to make loans. For example, if the reserve requirement is 10%, a bank can lend out 90% of the money it receives in deposits. This creates a multiplier effect, where each dollar deposited in a bank can create several dollars of new money through loans. Interest rates play a crucial role in how banks operate. The interest rate that a bank charges on loans is a key factor in determining its profitability. Banks also compete with each other to offer the most attractive interest rates to attract customers. The central bank of each country can also influence interest rates through monetary policy, such as raising or lowering the target interest rate. In addition to interest rates, banks also generate revenue through fees. These can include account maintenance fees, ATM fees, overdraft fees, and more. While these fees can be a source of frustration for customers, they are an important source of revenue for banks. Banks are subject to a wide range of regulations to ensure their safety and soundness. These regulations are put in place by government agencies and central banks. Some of the key regulations include reserve requirements, capital requirements, and restrictions on risky investments. So there you have it, a basic overview of how banks work. From deposits and loans to reserve requirements and interest rates, banks play a vital role in the economy. If you have any questions or comments, please leave them in the comments section below. Thanks for watching.